Over the last few months, we've witnessed many things we've never seen in markets or the investment world before. And the Fed and the central bank is now doing the unthinkable. It's going to have a massive impact for us. And most people, they're not even paying attention. But in this video, I'm going to explain what they're doing, the dangers, and what we should be doing about it. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I like to talk about making money, investing money, having overall success. If you like those topics, which I'm sure you do, click the like button, hit the subscribe button and the bell notification if you're not already, so you're notified when I put new videos out. All right, now, over the last few months, a lot's changed. A lot's changed in the investment world, the markets. I mean, we've seen interest rates plunging all the way to zero. We've seen trillions of dollars that have been printed and pumped into the system. We have this unprecedented illness that just, it's keeping the market from getting back. People can't get back to work. But one thing that's remained the same is that the Federal Reserve has continued to try to keep the economy from collapsing. They've been trying to keep this economy from collapsing for decades now at this point. We've seen them really double down after the 2008 financial crash, and they're doing the same thing now. They're doing everything that they can to keep the economy from collapsing. As big of the move was in 2008, what they're doing now is completely unprecedented. It makes what happened in 2008 look tiny, like child's play. And what they're doing now is the Fed is going to start buying junk bonds. And by doing this, they're basically bailing out the stock market. And I guess, why not, right? If everyone else can get a bailout, then why shouldn't the Fed just bail out the stock market too, right? Well, I guess the reason why is because it breaks the market. What do I mean by that? Well, the stock market is broken. I've been talking about this for a while. So let's dive in and see what they're doing, why they're doing it, and how it affects you and me. These types of videos take a lot of research. They take a lot of time and effort. So if you like this info, make sure to click the like button so I get more likes so I continue to make this content for you. Maybe even share the info if you like it, if you think someone else could use it. All right, so let's go back. We're not going to go way back in the history time machine, but we're going to go back just a couple months to March 23rd. And we saw the Federal Reserve announced that they would purchase unlimited assets to support the market. And it was really since that day that we saw the market basically snap back. The market had been in a massive decline. The Fed came out and said, we're going to buy anything. We're going to buy unlimited assets to support the market. And since that time, the markets have been rebounding. So what does unlimited support for assets mean? Well, let's look at how the stock market works. So companies that are listed there publicly, they take on debt just like most of us. But what they do is they issue a bond. All right. So when they issue a bond, that's taking on debt, and the bond is what specifies the terms of the bond. So it talks about how much they're borrowing, how much interest they're going to pay, when they're expecting to pay it back, et cetera. So it's kind of like if you or I were going to take a loan or borrow something, we might do like a promissory note. It's sort of like the same thing. The thing that's important to understand is that typically businesses produce goods and services, and in return for those goods and services, they get revenue, and they use that revenue to pay for employees, to pay their bills, etc. They also pay other businesses. They pay other businesses that are vendors to them, and those vendors rely on them. And then those other businesses pay other businesses, and on and on and on. But what's happened is over the last couple months, there have been no products. There have been no services. And if there's no products and services, that means no revenues. With no revenues, they can't pay employees, they can't pay their bills, they can't pay other businesses. So many businesses, they want to borrow money. They want to borrow money to keep them in business until hopefully at some point things turn around. Since they're not bringing in money, they'll borrow money to hopefully keep going until they get back on their feet. It's sort of like, if you or I were to try to live off of a credit card. Let's say we lost our job, we can't afford our bills, and so we're living off of credit cards or maybe our home equity line until hopefully we get our job back, right? Until we get back on our feet. And that's essentially what they're doing. The problem is that nobody wants to loan money to someone that's broke. Right? Of course not. It's easy to borrow money when you don't need it, but when you need the money, nobody wants to loan it to you, right? Nobody's going to loan you money if there's no way for you to pay it back. I mean, no banks, no institutions want to take on this risk, especially not right now, right? Now is definitely not the time to be taking on more risk in this current environment. You can't blame them, right? I mean, we're all hunkered down. I bet every single one of us wishes that we had a little bit more savings right now. And so trying to loan money out to risky people, risky institutions is not the thing that most of us are thinking about. But what about the businesses that need money to keep paying the bills, right? If they don't pay the bills, it triggers this giant domino effect. And then, like I said before, like those vendors can't pay their bills, and then those vendors can't pay their bills. And next thing you know, the whole system comes crashing down. So don't worry. Here comes the Fed to the rescue. They told us, hey, don't worry about it. We're going to buy your bonds. Nobody else wants to buy your bonds. Nobody else wants to take your debt because it's too risky, but we'll buy your bonds, right? We have some money for you. Oh, by the way, we have money for you. And oh, by the way, we got money for you and for you and for you. We have money for everybody. So like I said, these bonds are debt. And at some point, the debt is going to have to be paid back. But here's the thing. The Fed controls the interest rate. And why not, right? Why wouldn't they? They created the money out of thin air. It didn't cost them anything. So why do they care how much they get back? But what's unusual here is that the Fed typically buys bonds to bail out states, counties, municipalities, things like that. But now they announced they're going to be buying corporate bonds. And the most alarming piece of this is not just corporate bonds, but they're going to be buying junk bonds, which means basically companies that are risky. These companies are risky and they shouldn't be getting loans in the first place. And now they're going to get free money from the Fed. Here's where it gets interesting. Once the Fed said they would support these bonds, the market started buying the bonds up. The whole market started feeling like, well, hey, if the Fed's not going to let the market collapse, then we can go in and buy them because we know they're not going to collapse because the Fed's going to buy them. And so because the market moved in and bought them, the Fed never had to. The Fed never had to even start buying them. They just signaled that they did because the markets already were. Billionaire Jeffrey Gundlach tells us that basically the Fed just faked us all out. They said they were going to do it, so everybody moved in front of them, but the Fed never did. So they faked us out. But then the Fed went on to say that they will start buying corporate bond ETFs in early May, which is right now. Now, what's important to know in all this is that they really can't. The Fed can't just go and they can't just go do this openly. Per the Federal Reserve Act of 1913, they are strictly prohibited from owning these companies' debt directly. So they can't buy it directly. So instead, what they're doing is a sly roundabout way using something called an SPV, or what's known as a special purpose vehicle. And so basically what's happening is the Fed creates this special purpose vehicle, this SPV, and the Fed loans the money to the SPV. And then the SPV will go and buy the junk bonds directly. They'll even buy the stock directly. They can do whatever they want. It's kind of like if I was banned from buying stocks directly, and so I just set up a corporation, and then I had my corporation buy the stock. So, I own the corporation, which owns the stocks. I just don't own it directly. So that's kind of what they're doing. And like I said, doing this, it's completely unprecedented. And what's even the most crazy part is that they're doing this with junk bonds, all right? Now, that means basically what junk bonds are is they're the worst debt. Now, bonds have a rating, a credit rating, a credit worthiness, kind of like you have a FICO score. Bonds have a rating from a AAA all the way down to like a D, right? And so AAA or prime is called like investment grade, and anything below a B is basically considered non-investment grade or junk, right? As the name would say. Now, the problem with this is enormous and it's many faceted, all right? There's lots of problems with this. But as I've been saying, as I kind of started out saying, the market's completely broken. And what I mean by that is these companies are broke. These companies don't have any profits. They don't have any earnings. And so what would typically happen is they'd be at the mercy of the market. They're broke. They don't have any money. They need to go get money. Nobody wants to loan them any. And so they're going to have to pay whatever rate and deal with whatever they're going to have to. They would go to investors like Warren Buffett. And Warren Buffett would typically get a sweetheart deal and he would reorganize them to be profitable again. Now, if you saw my videos from last week, you know that I showed that Warren Buffett is not buying these companies. As a matter of fact, he's sitting on $140 billion of cash because he doesn't see any good deals right now, right? He would typically get a sweetheart deal. He would reorganize them, help them find their way back to profitability. This would also cause the stock to drop. Now, when the stock drops, that creates a good opportunity for me, creates a good opportunity for you to jump in and buy these companies at great valuations. But instead, the Fed's giving them money. And it's creating zombie companies that just take on more debt and take on more debt, but it creates more of the same problems that they're already dealing with, all right? Now, when you can't pay your debts, adding more debt is usually probably not the best thing, right? Like when you're broke and you don't have any income coming in and you're living off your credit cards, you can't pay the debt you already have. Taking on more debt isn't usually the answer. That's exactly what we're seeing here. Instead of reorganizing, instead of doing the hard things that lead to growth in the future, they're doing the easy things. They're turning into zombies that are going to make it very, very difficult for them to grow in the future. In addition to this, it keeps the stock prices artificially inflated. Now, these stock prices should be coming down, like I said, creating good opportunities for us, but it doesn't. It keeps the stock prices artificially inflated, breaking what's known in a free market as what's called price discovery. So price discovery is when it moves up and down, it tries to find what the price is based off what people are willing to buy and sell. All right. But we've broken that. There is no price discovery. And because of what the Fed's doing, their intervention, there's no good value investments for us right now. So how is this all going to play out? What should we expect? And I guess more importantly, what should we do? Well, like Warren Buffett, we don't have to do anything. Sometimes it's important to understand that doing nothing is doing something. So we can do nothing, we can do something, which is nothing, and we can just wait and see, all right? We can take positions in like assets that are doing good, like gold. We can take positions in Bitcoin, other types of hard assets like that. We can still invest into cash flowing assets. And then on the rest, we can just kind of wait and see, right? We don't have to take action. We can wait for that fat pitch. Let's go into the investments, into the asset classes that we know are doing good right now. Let's wait and see what happens with the market. All right. That's what I'm doing. That's what I'm suggesting. Leave me a comment. Let me know what you think. Are you anxious to do something? Are you feeling the FOMO like you need to get back in the markets? Are you more like Warren Buffett, a little bit chill, a little bit relaxed, waiting for that fat pitch? Let me know in the comments down below what you think. Give me a thumbs up on this video if you like it. If you don't like the video, that's okay. Give me a thumbs down either way, but let me know what you think because I always love to have discussions with each and every one of you. That's all I got for you right now. To your success, I'm out.